Up now we have James Roy Poulter, who's the CEO at Blockchain Reserve. He began his career in finance at EY, moving people, capital, and companies around the world, and has been recognized in the 35 Chartered Accountants Under 35, as well as the Forbes 30 Under 30. Can you please give him a very warm welcome to the stage?
Hi everyone, I'm James Roy Poulter, CEO of Blockchain Reserve, and I'm here to talk to you about the future of early stage technology financing, or at least some of the reasons that I actually think the ICO is dead. I want to kick off by just briefly kind of like understanding how we've got here, right? Like why we care about ICOs, like how or why this market's evolved around this. And it starts with some of these points. I think a key innovation that's come so far in the event of ICOs at these early stage instruments is the liquidity in those instruments. And there's been this, this benchmark figure of a 10% premium on evaluation because something is liquid purely for that reason. But we're still trying to understand the implications of liquidity on the economics of this space. Is the venture capital model of 2 and 20, 2% management fee and 20% carry, the right model in a world where the assets that you're investing in are actually liquid and you have the option to take return, not in a 10-year cycle, but in a 6-month cycle. We care, or at least there's been this democratized access to ICOs. And because it has been democratized, we've had this sort of embedded user acquisition into these networks and these companies that we've been building. And because it has been so decentralized, there's all this new capital which has kind of entered the market, which these companies and projects did not have or did not necessarily have access to before. There's just a reality that I think 37% of all venture capital is on one road in Silicon Valley called Sand Hill Road. And what's been happening over the last 18 months is I guess a complete democratization of it does not matter where you are in the world. I think what's great about ICOs as well is that you're giving more power to the entrepreneur. They're able to stand and fall on the terms that they set. If they get that right, they can do well here in this space. If they get that wrong, then it's kind of their fault. And actually, the reality is that the traditional venture capital space for funding early stage technology companies is the data proves that it's incredibly biased and very discriminatory. I think the reality is that last year in the US, 2% of venture capital funding went to female founders. And there's been some really interesting stuff, and I'd recommend you have a look at, for example, Social Capital, where they've been looking at making data-driven investments into seed stage companies, where you take that bias out and actually you start funding 15, 20 times the women. So again, there's some great advantages that ICOs have had, but I think these are the good reasons that ICOs have had the success they've had. But I think there's a reality that there are some potentially bad reasons, which are potentially more important factors in why this sector has grown so rapidly over the last 18 months. And that's that one, there's no regulation, or at least people are pretending to themselves that there's this gray zone, and these instruments don't fall under what's out there. There's the fact that projects with absolutely zero traction, that do not have products, potentially barely do not even have teams, are able to go out there and raise significant amounts of capital. And raise significant amounts of capital in return for giving up no rights and with no ownership or loss of control. And I think if we were being really honest with ourselves as a sector, these are probably 3 bigger reasons than all these great reasons as to why the sector has had such rapid growth over the last 18 months. Now, the problem is that this last reason here is that most of these tokens that we are playing around with do not actually have any rights or rules of fundamental value. And I think there's a sad reality that over the next 12, 18 months, a lot of people in this space are going to learn this the hard way. I think there's a reality by my estimates that actually 20% of all people in crypto are already underwater because everyone that effectively has joined since mid-December is in the red. But yes, we're going to learn the hard way. I think that instruments have to have real value. And they will start to have real value. And again, most of the clients that we work now are looking at giving tokens things which do have value, whether that's voting rights, whether that's the right to participate in an exit event of some description, whether that's a right to a dividend in the future. But the problem is, as soon as you start giving a token rights and attributes which do have value, they become securities. And so what we're looking at is at the minute, the only reason we're able to get away without this regulation is because we're issuing things which have no value. And as soon as we start to understand or start to realize what value means, you start working with regulated instruments. And this has potentially negative consequences for the space, or at least short-term implications. So this means if we're looking at securities, that the instruments that we're working with are subject to regulation. And that a lot of the activity and the way that you see these companies and projects are raising capital out there at the moment are just simply illegal. They're not allowed. And so we've seen some of this start to come through. Well, look, actually first, these processes are incredibly expensive. I think anywhere between $250,000 and $2 million to do something properly from start to finish. And actually, at the higher end of that spectrum, you can actually take a normal company public on a standard stock exchange. So there's very little innovation here, actually, in taking companies public at the moment. And it's going to get harder. The reason the budgets are so high, to raise this capital is because you are marketing to consumers, and you have to get so many of these individuals to participate in your project to get the sums of money that you're after, which is why you end up spending hundreds of thousands, if not millions of dollars. But as we've seen over the last months, as Facebook, as Google, as Twitter, and as every other site that is, that's being leveraged in this space can no longer offer, the advertising space for, instruments which are regulated securities, unless you are treating them as such. It's only become more expensive or more difficult to access that capital, which is decentralized and distributed across the world. And so when we actually look at public sales at the moment, in the reality what they are is expensive, super time-consuming, and fairly risky from a regulatory perspective. Whereas private sales, which are taking up a larger and larger amount of the ICOs that you see out there. A year ago, you were only looking at potentially 0 to 20% of ICOs being conducted privately, or of the round being done privately. Whereas it's been completely flipped now, and the reality is most better projects now are raising 80% privately and 20% publicly. But the only reason they're even bothering, again, in our experience, to raise that 20% publicly is because to get the liquidity that everyone's playing in this space for, you need that public, decentralized global interest for the exchanges, which are the gatekeepers in this world, for the exchanges to put you on their markets and get the liquidity that everyone's after. But as soon as that problem is solved, you're going to see most projects, in my opinion, completely stop raising from the public because it is harder, more time-consuming, more expensive, and far riskier from a regulatory perspective to raise from the public across the world than it is to raise privately. So, with that sort of set in mind, I think there are some things that we probably can agree on. One is that blockchain, or at least another distributed ledger technology, is an incredible place to be issuing and then storing and transferring title of assets, like equity instruments or debt instruments. And I think we can agree that some of these, distributed ledger technology kind of issued instruments will be liquid. And again, in pre-sales, that's not always the case because people tend to be locked up for a while. But again, still, some of these instruments will be liquid. And then some of these liquid instruments will be listed on exchanges. And then maybe all that we're going to come up with here is that the innovation in this space is effective that we may end up reducing the cost and effort and time that it takes to take a company public, and the way that we effectively end up democratizing access to early stage instruments is not that they're participating in an ICO, but that actually we are taking companies public on stock exchanges, on regulated exchanges, where then the public can participate. And what's interesting about this is that the future of this space is actually what's been happening for decades, where you have companies raising books privately, trying to price their stock accurately, and then listing and becoming open to the public on a regulated stock exchange. The future, in my opinion, at the moment, is the past, and we're going to see this play out, over the coming months. And well, actually, I don't think it's going to take years. I think it's only going to take months for this to come to fruition. And then again, what is the point of going public early? When that's the reality, when it comes back to that world, what's the point? And it comes back to this liquidity. And I think there are some really, really interesting implications of having this early stage liquidity and fundamentally taking companies public at the earliest stage in a project's lifetime. So I think there are some things that we're all going to have to start thinking about as an ecosystem as we mature and if we want this space to survive. I think like a good example is reporting standards. Again, you have to understand that if you are ICOing, you are taking a company public. And even if right now you may not have responsibilities because you've issued an instrument which has no value, that will not be the future. And that as these become securities, you will be incorporated into a whole body of law, which means that you have to be reporting accurate, timely information to your community, a nice word that we've all grown to use when the reality is we all know they're investors. But reporting standards are going to become increasingly important. Insider trading is rife in the sector. And again, you don't have to worry about it too much when the instruments aren't regulated. But again, the reality is they are regulated or they will be regulated. And a lot of the activity which is happening in this space is illegal. And so insider trading is going to have to come in and be a part of the processes that we deal with and how we engage with our communities. And again, communities, that word's going to phase out. The community managers that you see in Telegram are investor relations teams. That's what they are. And we can pretend they're not, but whether it's the Securities Exchange Commission or whether it's European jurisdictions, if you are issuing instruments with an expectation for them to be, making a return for those consumer investors, you're dealing with investor relations, and we're going to have to see companies that are going public early really, really push the bar on how they handle their investor relations. I talked about this briefly earlier. Like an interesting implication of this entire, disruption to early stage financing is the economics of early stage investing. So, investors that would traditionally charge a 2% management fee and take 20% carry on a fund or a set of investments that were locked up over 10 years, that model, seems to be incredibly inefficient versus the opportunities that there are out there now. And I think we're going to see some fundamentally different structures come into play and become the norm now that we could have this early stage liquidity. But I think it's important to say that to have this early stage liquidity, we need the process of doing these things to become more reasonable from a cost perspective. You can't be paying $1 million to Binance to go public, or this doesn't work. And I think what's potentially one of the sadder things about this is that as these become securities, and as these public sales, again, which are already happening, right? Again, a majority of capital in ICOs is being raised privately already. This is not like this is coming, this is already happening. But like this democratized, decentralized access to this stuff just kind of ceases to exist in a way. And I think that, again, if you look at the UK and Europe, we have a history actually of innovating in crowdfunding and equity crowdfunding, which is where this space will end up nearer to as well. And that there are ways with regulated instruments that you can still get the crowd to participate, but it requires regulation, having authorized status with the jurisdictions that you're working in. And that's part of what we work with. And actually part of how we're trying to solve that last problem, the fact that suddenly the crowd is no longer able to be involved in this new wave of innovation, is by putting proper investment structures in place that are regulated in the right jurisdictions and are able to deal with the future of what this space is, not the current kind of like gray area. And I think that, again, just finally, I think it actually links back to to that final slide of the previous presentation. And I think that what this all does represent in getting this early stage liquidity is an opportunity to perfect capital allocation. And again, that's what we do as a business. We're here helping the absolute best management teams in the world raise capital from this space. But that's my time, and I thank you all for this, and I would encourage you all to come and talk to me about this problem, because maybe I'm wrong, and if you disagree, I would love to hear your thoughts on this. So thank you very much.